Okay, good morning. Thank you for joining our webinar this morning. Just a few housekeeping issues just to get us started. Just to mention that this is a webinar and it's not a meeting. So you can see and hear me and our presenters, but that does not work the other way around. We have a list of participants who've logged in this morning, which brings me to my next point, which is CPD. So should anybody require a CPD cert, you can email myself or Sean after the event. There will be a questions and answers session at the end, so you can submit a question either online through the functionality within Zoom, or alternatively, you can email myself or Sean. Now, there's just one slide that I just want to show you before we get to our speakers. So this is in the context of one of the budget announcements yesterday, which was that the standard rate band of tax is increasing by 2,000 to 42,000, and just how this ties in and supports pension scheme tax efficiency. Okay, so hopefully you can see that slide in front of you, and in the middle box we're just taking an example of somebody with an 800,000 pension fund at maturity. So in your mind you can have the stereotypical example of a 65-year-old. And let's just have a look first at the inputs that help them achieve that level of funding. So there's three inputs at the top. So the first would be the immediate tax relief and contributions. So at this time of year, we have a lot of people doing AVCs, and they're doing that and backdating against 2022 and claiming 40% tax relief. So that first input is that 40% tax relief. So for every €100 they're putting in, the taxman is funding 40 and they're funding 60. So that's the second input, is the net contribution cost to them, to the person. Now, also that's talking about AVC and employee contributions. Employer contributions are even more tax efficient. So with employer contributions, not alone is there an income tax saving, but there's also a saving on PRSI and USC. So many one-person limited companies that I would deal with might actually ignore employee contributions in favor of focusing solely on employer paid pension contributions. So then the third input in there is the tax-free investment growth that you get on the fund. So I suppose that's a combination of two things. It's where you're invested, the type of fund you're in. So for instance, there might be dividends coming into that fund, capital gains coming into that fund. And the other element of that is its tax-free status. So it grows away tax-free. Now, just what I find when I'm sitting down with someone, and let's say we are at this age 65 example, and if they've been contributing to a pension for a long time, let's say over 30 years, or sorry, over 20 years would be enough, that I would see that fund is breaking down. Those three inputs do work out to be roughly three equal euro amounts. So for instance, of the 800,000, one third of it, or which would be 267,000, would result from the immediate tax relief they got on contributions. Another third of it would result from that tax-free investment growth over all those years. So the final third of it, so roughly about 267,000, is what has come out of the person's pocket for their net after-tax contributions. So then just to have a look at the outputs. So what happens to that 65-year-old when they're drawing down their funds? So you can see that they will get 200,000 of a tax-free lump sum, and then the balance 600,000, they could use that to buy an annuity, or they could invest it in an ARF. Now, just using the ARF as an example, they will be effectively obliged to withdraw 4% of that per annum, which is 24,000. Now, that is still 18,000 short of their standard rate band. So they can earn another 18,000 at the low rate of tax. So for instance, their state pension might be another 15,000, bringing them up to 39,000. They still have 3,000 left. They might have other income, they might have dividend income. If they did not, they might consider drawing down another 3,000 from their ARF, safe in the knowledge that they will be avoiding 40% income tax on that. Also with these numbers, just to bear in mind, that's per individual. So for instance, a spouse could have those same numbers. So rather than 42,000 coming into the house at the low rate of tax, they could have 84,000 coming into the house at the low rate of tax. Now, if you just cast your mind back briefly to your Leaving Cert days, you recall that there was a pass maths class and an honours maths class. So what I just went through there was definitely from the pass tax class. Our second speaker, Brendan, will bring us through the honours paper a bit later. But before we get to Brendan, it gives me great pleasure to welcome our first speaker. Daniel Moroney is an investment strategist with Brewin Dolphin. Daniel builds and maintains long-term investment plans for high net worth individuals, corporates, pensions, and charities. Having been recently acquired by Royal Bank of Canada, Brewin Dolphin now has additional resources and capital to grow and enhance their overall client proposition. Brewin Dolphin manage over €60 billion worth of client assets worldwide, of which €4 billion relates to client assets in Ireland. Over to you, Daniel, and thank you for taking the time to be with us here today.
Thanks, Owen, and good morning, everybody. I'll just put my slides up here. You might let me know if you can see them. Looks like it's working from my end anyway. So the title of this morning's presentation, Markets at an Important Juncture, I think that's a pretty apt title given the type of disruption that we've had in global financial markets. And I don't mean just stock markets, I mean all global financial markets over the last 18 months or so. It has been it's been a remarkably difficult period for investors in any asset class, really. Probably the most difficult place to have been is some of the so-called conservative long-term asset classes like long-term government bonds. So maybe I'll just give a little run through about what's happened and what we believe at RBC Brewin Dolphin is the best way for people to think about protecting their long-term purchasing power, because oftentimes that isn't intuitive, and doing things that we are told are conservative can often be the wrong thing to do for long-term protection of purchasing power. Just at the outset here, I'd if I can get these slides to move along. See, seem to be moving there. There we go. A little bit of a delay maybe. So we had an interest rate shock. See in this chart, this is a 1-year German government bond. So this is the safest place to park short-term cash in the Eurozone. And you can see here, this is below negative for a very, very long period of time recently. We had a negative rate until in the early part of 2022, started going above zero and right up into positive territory. Whereas now we're at about 3.7% for this short-term cash rate. This is an extraordinary move in an extraordinarily short period of time. It's an interest rate shock. There's no two ways about it. And what happens when we have an interest rate shock is we've short-term dislocation in how we value all types of financial assets, bonds, shares, property, you name it. This is an incredible shock to the system for anybody trying to put a fair value on any assets. And what has been the surprise about this interest rate shock, and it's been global, the surprise has been we haven't seen a massive global recession, which was much predicted. There was a much feared global recession that was coming. And, you know, there are many reasons for this, but one of them, I think, is encapsulated in this chart here. This is a US-based chart. So in the same period, US short-term interest rates, government bond rates in the US on a short-term basis have gone from effectively zero to about 5.5% in 18 months. An extraordinary interest rate shock. But what we've seen is the US economy and the US consumer in particular have been able to weather higher rates. And I think part of the reason is in this chart here. It's showing the ratio of leverage liabilities to net wealth in US households. And the long-term trend is in this diagonal line since 1960. And what you can see is around the turn of the millennium, US households became heavily overborrowed. It's something that we obviously are familiar with in this country as well. And then when the global financial crisis hit in 2008, 2009, we saw several years of belt tightening, paying down debt, repairing of household balance sheets. So what we actually got through all the bad things that are associated with the global financial crisis and all the difficulty that this period of deleveraging of personal households represented, one of the kind of benefits of it in the long run was when this interest rate shock hit last year, we were in a much better position to weather that interest rate shock. Households in generally were able for higher rates, and we didn't get this recession that everybody feared. Now, there may well be a recession, and inevitably there will be at some point, but a big, deep global depression or recession didn't occur. And that was what was the common wisdom, the conventional wisdom this time last year was that was absolutely inevitable. It didn't happen. We've got favorable inflation trends as well. The cause of the interest rate was obviously this spike in inflation. This is US consumer price inflation, which is one of the more relevant pieces of data when we're thinking globally for investments. And we've seen this roll over massively. The big spike there in 2022. And these measures are coming right back down into the kind of normal territory that we've been accustomed to over the last few decades. So a normalization of inflation is a very positive thing, obviously, when that was really what caused the initial issue and the ructions in markets over the last year and a half or so. We've also got valuations that are reasonable in the global equity market. I won't go into too much detail in this slide, but what it's showing is on the bottom here is the forward earnings yield of the global stock market. So you take the expected earnings over the next 12 months and divide it by the price of the global stock market, just like a rental yield or anything you get like that. And the starting earnings yield for the global stock market on a forward-looking basis is about 6.5%. So 6.5%, I think, is for anybody would be a reasonable starting point from an earnings yield. That, of course, with shares over the long term, we have a very, very reasonable expectation that earnings yield will grow, that the earnings will grow over time. We don't know much on a short-term basis, but over time, at a 6.5% starting point with growth as well, we can expect pretty good returns as a long-term investor in the global stock market from this juncture. It's one of the things where, because the market fell, we can expect better returns from this point in the future. It's nearly that simple. One thing I'd really like to highlight, and something that we've been highlighting for a very long time, was during the era of zero interest rates or negative interest rates, it was very obvious that this was not a good situation for savers. What I'd like to make very clear is, just because we see the nominal interest rate go up, we see that German one-year bond go up to about 3.7, as I showed earlier. Here it is again. You know, you've got this availability of a one-year rate. It looks like it's very attractive. It looks much better than, say, we had back here. That's 2016, where that rate was about minus 0.5. The green arrow there is where we are today, or where we were last year, in and around north of 3%. So if I was to ask most people, I think, which is the better rate for savers, where the green arrow is or the red arrow is in the short term, I think everybody would say intuitively, or most people intuitively would say, well, it must be the green arrow. The answer is, in the short term, the red arrow. And it's something that, again, this is something that everybody understands, but oftentimes you'll find people don't put the pieces of the puzzle together when they're thinking about their own short-term cash. So we have to factor in inflation. This is Irish consumer price inflation table from the Central Statistics Office. And it just shows that when we had the red nominal German one-year government bond, the safest place you could park one-year money in the entire Eurozone, we had no inflation back then. So you're minus 0.5% or so in 2016. After inflation, it was still minus 0.5%. Obviously, this isn't good, but it's, when you factor in inflation, you get your real after inflation interest rate. It was actually better than what we got last year. So your green arrow there, you're getting north of 3% from the German government. But inflation, CPI inflation in 2022 was up about 8%. So you take that inflation rate off the 3 and a bit you're getting from the German government, and you get your real rate. And the real rate after inflation rate is all that matters. That real rate was materially worse than what we were getting in 2016. But so many savers will be tricked by this nominal rate going higher and fail to factor in inflation into their calculation of what am I actually getting? What's my real after inflation rate of return? So the question then is, obviously, how do we protect purchasing power in the long run? And to be clear, I'm not suggesting for 1 minute that we don't have any cash. Cash has great value. Cash is there for liquidity. Cash is there for short-term spending requirements and to safeguard spending for the course of a year or 2 or 3, perhaps. But we also need to think differently if we're going to really protect our purchasing power over the long term. Sitting in cash will just give an illusion of safety. Inflation is coming down a bit. That situation is improving in Ireland. That's you can see clearly the annual inflation is coming down. It was 8.5 year on year back in February. In the summer, it was down at around 6. It's improving, but we need to protect ourselves against this dynamic where this is just what happens to wealth. If you get nothing on your cash and there's 2% inflation, it is clear you don't need a degree in mathematics to work out what happens to your purchasing power over time. But the problem with it is, in this example, 100,000 euros in the bank at zero, optically it'll look like it's just staying at 100,000 as the years go by, but really what's happening in terms of real purchasing power is the absolute destruction of purchasing power. And that's the real risk that we need to be concerned about as investors. So equities are what protect long-term purchasing power. Real assets protect long-term purchasing power. I'm using shares as an example here, but you can also see examples of that in other real assets, such as property over the long term, if we're picking and investing on a long-term basis at a good entry point. There's a very stark example here that comes from a long-term equity gilt study that Barclays produce every year. It's the value of $100 invested at the end of 1925. Now, this data goes up to a few years ago, but it's long term, so it doesn't matter. It hasn't changed the long-term picture at all. The fact it isn't quite up to 2023. If you invested $100 in cash, and I know 1925 is a long time ago, but oftentimes people are thinking of generational wealth. They're thinking of wealth for their grandchildren. They're thinking of how they can keep wealth within their family and protect the purchasing power of that wealth. So if you can imagine a great grandfather or the likes putting $100 in a bank account 100 years ago, and if a family had just left it in the bank over that period, the $100 would be worth 2,000 today. But that's the nominal value. The real purchasing power in terms of $100 in 1925 terms, it would have gone up by about 50%. So you'd have the equivalent of about $150 for sitting in the bank over the course of nearly 100 years. If instead the great-grandfather had parked that in 20-year US government bonds and kept rolling it into 20-year US government bonds, and the family had continued to do that, believing that long-term government bonds are a safe place to keep your money, well, it would have been okay. It would be fine. You know, the $100 would be worth about 14,000 today in nominal terms. In terms of real after inflation purchasing power, the purchasing power would have gone up about 10 times. It would be about $1,000 in terms of 1925 dollars. So it would have done okay, and purchasing power would have been protected. Indeed, it would have grown. But if the $100 had been put into the US stock market and income was reinvested over the course of that same period, the $100 would be over $500,000 in nominal terms today. And the purchasing power would be about $40,000 in 1925 terms. So it's pretty stark to see the massive improvement you get in terms of protecting and growing purchasing power if we move from cash into slightly more volatile assets, into purely volatile assets like equities. And it goes to show that for long-term investment, volatility is not what we should be thinking of as being risk. If we're diversified and if we've high quality assets, volatility is what we should actually be seeking out and enduring, maybe grudgingly enduring it, but it's the volatile assets that will actually protect us against the real risk we should be protecting ourselves against over the long term, which is destruction of purchasing power. There's an illusion of safety of sitting in low volatile assets like cash. It is an illusion. It's very helpful for the short term, and cash has its place, to be clear. But once sufficient provisions are made in terms of short-term cash, then we must look at more volatile assets and do that in a responsible way to really protect our purchasing power of the long term. So a couple of examples of that, of how we would invest in terms of protecting long-term capital. This chart is showing a free cash flow yield. So it's similar to an earnings yield or a rental yield, but it's taking the free cash flow of a business and dividing it by the share price. So free cash flow effectively is once the business has covered all its operation costs, paid all its staff, done all its maintenance to its buildings or its plant and equipment, and done all the type of capital expenditure that's required to keep the business going. After that, you get free cash flow left over, with which the management of the business can do whatever they want. They can pay a dividend, they can go buy another business, whatever it might be. That's free cash flow. And the free cash flow yield of this company, Johnson & Johnson, currently is about a little under 6%. Again, like the earnings yield of the stock market, Johnson & Johnson, I think we can reasonably expect them to grow that free cash flow over the long term. They mightn't do it next year. They might have difficulty over the next year or two. We don't know. But certainly over time, they've an exceptional long-term track record of growing their free cash flow. So if you can buy a company like that with a long-term time frame and a starting cash flow of about just under 6%, and it can grow, then that's a pretty good place to start thinking about your long-term capital protection, your long-term purchasing power protection. By all means, you would never be buying one or two shares of high-quality businesses, no matter how high quality they are, we must be diversifying in this type of pool, this type of quality business that has a long-term track record. Another example here, offering a free cash flow starting at about 4% is LVMH, an exceptional business that has been able to allocate its capital very well over the long term, and a company that has delivered returns for shareholders for a very, very long period of time. And one final example of this, a quality business that protects long-term capital. This is at a starting yield similar to Johnson & Johnson in around 5.5%, 6% in terms of free cash flow yields that, again, we should expect to grow over time. All of these brands here come under the banner of Unilever, an incredibly high quality business that has an incredibly strong suite of brands under the bonnet that are largely recession proof. They have some pricing power, but most importantly, an exceptionally long-term track record of delivering returns for shareholders. None of these are stock recommendations, nothing like that. It's just to show you the example of the type of companies within which we should be looking and within which we should be diversifying and holding dozens, if not even more, hundreds of this type of business and taking a long-term view. They'll be volatile. They'll give us a run for our money. When the markets fall, these shares will fall as well. But these are the exact type of assets that will actually protect us against that real risk of losing purchasing power. And in an environment like today, where we've had a bear market last year and we've had a lot of volatility, it can be difficult to think in terms of the long term and to endure the type of price falls we've seen in stocks over the last 18 months. But it's precisely because we endure those falls that we will protect long-term purchasing power over time. Markets climb a wall of worry, they say. This chart is going back to March 2009, the bottom of the stock market, where since then, the global stock market, or the US stock market in particular, has gone up about 7-fold. And during that period, back here, all the way through, there were all these various different events that would have given somebody reason to say, actually, I'll hold off investing, or I'm going to go to cash now. And none of these things are conspiracy theories. Nothing's made up here. It's real events that happened and had concerns. You know, US government shutdown. We had a downgrade of the US debt back in 2011. We had another one a few months ago. We've had global stock market sell-offs, global pandemics, more government shutdowns, trade wars, global health emergencies, massive bear markets, all this type of stuff. And yet, a dollar invested in the US stock market at the beginning of this period would be worth about $6 or $7 today. So that message is just to show that if people are thinking, okay, maybe I should be investing with a long-term frame of mind to a certain extent in diversified high-quality stocks, but did you not just see what happened over the weekend? Or there's this thing that's coming, or there's a US election next year, or there's all these things that are read about in the press. That is always going to be the case. If we're waiting for the coast to be clear, nobody will ever invest a penny because the coast is never clear. Markets tend to go up over time, but they climb this wall of worry. And it's very important that we're aware of that and we accept that it's never going to feel perfectly comfortable to invest. In fact, if it ever did, that might in itself be a warning sign. I think the last time I can think of where people were tripping over themselves to invest money was probably about 2004, 5, 6. And we all know what happened then. That was investors getting carried away, excessive animal spirits or optimism, and people borrowing money to invest. That is an environment where maybe we should have some pause. But for the most part, this is the environment that we're operating in. There's always something to have concern about. I just wanted to point out something that happened last week as well, and I'm nearly at the end, and I appreciate I'll be respectful of the time allotment I was given. This happened last week, and I think it's a perfect example of how it can be very difficult to invest as a private investor, taking a diligent look at the media and reading the news and keeping up to speed with current affairs and market news. The framing sometimes, the negative bent that media generally tends to have around markets is very detrimental to investor outcome because it stops people from doing the right thing and putting long-term plans in place. There was a massive monthly US job report out last Friday. And in the New York Times, before the jobs report, the headlines were along the lines of US jobs report for September is expected to be weaker. The markets are jittery and this jobs report could be pivotal. So there's framing, this could be weaker and markets are jittery. And if it's weak, the market could go wrong. Of course, what happened was blowout jobs report, exceptional numbers. And what did we get immediately afterwards in the New York Times? US job growth surges past expectations in troubling news for the Federal Reserve. Markets are jittery. Here's why the strong jobs report may not help. So heads, it's bad for markets. Tails, it's bad for markets. Obviously, this isn't the case, but this is how things are framed in the media. And it could be quite, I think, reasonable to think that somebody reading these headlines would think, oh God, okay, I need to hold off here, because no matter what happens, the New York Times is telling me I should be nervous. It's kind of force feeding negativity to me. But the reality is, for 99% of investors and for all of our client base, the US jobs report in September of 2023, released in October, is absolutely meaningless for their long-term financial health. It is, and I can't stress this enough, it's completely meaningless for somebody investing with a 10, 15, 20, 30 year, or even intergenerational time frame. This is what we're fixated on. This is the short-term noise, and it means nothing. But like, if you think about people that are retiring now and may have been contributing to a pension 20 years ago, what was the jobs report in September of 2003? Not relevant. It didn't matter. But nevertheless, there was no doubt that there were people that did things with their retirement savings and made short-term decisions based on that short-term noise that has had a material impact on the retirement pot they have today. And it's what we're almost evangelical about, trying to make sure our clients don't make the mistake of fixating on a too narrow basis on what's happening in the media today. There's another example from CNN, which was so blunt, I decided I'd put it in. Same thing. Why the shockingly good jobs report is going to cost you. You probably think some really great news about the job market will give American spirits a boost. It won't. I mean, that's just, it's almost laughable if it wasn't so serious. But this is the framing that we're thrown at us every single day. And people that should be making sensible, very long-term investment decisions are paralyzed by this kind of stuff. And it's not relevant to them. It's not relevant to their investment. So in closing, from my side, I just wanted to put up a final quote from Howard Marks, who is a very famous US bond investor. There is he has a namesake that was a Welsh drug smuggler, but it isn't that guy. It's the US high yield bond investor, Howard Marks, in this case. And he said something that I thought was very apt earlier this year. He said, psychology swings much more than fundamentals, and usually in the wrong direction or at the wrong time. And that's precisely how I think we should all be thinking about our long-term investments. What are the fundamental situations in the market that we're looking to invest in? Look at those earnings yields and free cash flow yields, reasonably valued assets that we can invest in and diversify and get good long-term returns. But psychology is swinging to and fro, and there's negativity in the media, and all of that is going to stop us doing and acting in our best interests over the long term. So that's it for me. Thank you.
Thank you, Daniel, for your very informative presentation, which I'm sure the audience will agree will be reassuring for the long-term investor. I'm now pleased to hand you over to this morning's tax consultant with over 25 years experience. Is a well-known speaker, author and contributor to tax journals. Over to you, Brendan Toohey.
How are you getting on, lads? I hope I'm going to do it, Daniel, and I'm trying to share my screen. I hope it works. We in business?
Yeah.
I was laughing at a lot of what you were saying, Daniel, because I had to go through a similar thing yesterday, listening to the context of our budget. I'm only 20 minutes, so I'll go very, very quickly. I have a lot of details on the slides because, you know, you don't need me to read it out. If you're interested, you read it. If you're not interested, you don't listen to me talking about it. But the pre-budget context, like, it's always unprecedented, challenging times. Always. And I was in a room with someone, believe it or not, like, we're all seasoned campaigners, but I was in a room with someone a little younger, and they're like, oh yeah, but like, you UK war, so like, we'd never had anything like that. I was, really? We didn't have any unexpected events in the 90s or the noughties, you know? We had a war in Europe in the 90s, in Europe and the Middle East, and there was 9/11 in the noughties. but they're all gone now, right? Ukraine is more important, but anyway, look, it's a sidetrack, but just listen to Daniel there with jobs reports and things. It's always today's paper that matters, isn't it? When we go through all the stuff that influence the budget, I like to focus on three things because they're the most important. One is global warming. At some stage it's going to dawn on us that's not going to go away, so it's always going to feed into our pricing and our taxing policies. Two is the aging demographic. That's not going to change anytime soon, unless I Live You Late does its magic and we all live forever. Three is the EU, right? And the fact we're moving to a harmonized tax system and our 12.5%. And it is quite interesting listening to the budget yesterday, or suddenly we're talking about windfall corporation taxes, right? Windfall doesn't mean what it used to mean. It used to be the basis of our entire economic system. No, we're acting like we always knew was a lotto win. And technology, which isn't mentioned much, which is hugely important, right? They are going to underpin everything going forward, and they're the important things that you need to keep in the back of your head. The rest of the stuff is just nines, right? So what happened in the budget? I'm going to ignore the Rose Tree stuff, about the Future Ireland Fund and the Infrastructure Fund and how we're all going to have unicorns and puppies and more guards and more nurses and sunshine from July to November and things. Just going to go on the simple stuff, and I'm going to pause at the things that you might miss because the devil is in the detail. So obviously the tax bands didn't change. No, I know you're all thinking, Brendan, you were on last year and you were talking about how the minister talked about looking at introducing a third rate. What happened to that? Well, funny enough, nothing happened to that because there was a report commissioned, and all this is hidden in if you go to the government's budget webpage, there's a lot of documents that feed into the budget. They're well worth reading if anyone has loads of time and a sad life. And one of those things was they did a report about the need for a third rate and the good, bad, and the different, and they concluded that we don't need one. We just need to do better with the tax band. Now, that's news to me and to anyone else I know. And then one of the persistent criticisms of the Irish tax system is the fact that you go from an effective tax rate very low and then you hit a wall, right? But apparently we don't. So in theory, at least that's off the table for a couple of years. It's important to note that the tax band changes are very welcome, but one, we're still less than we were in 2010. Bear in mind, 2010 was not the crash was 27/28. So 2 years later, when we were deep in recession, we were still paying less tax at the top rate than we are now. Two, we haven't got anywhere near the average industrial wage. And three, this own government's target was to get to 50,000 by the end of its term, which I think is next year. And we're still a long way short of that. So I would expect to see a bigger jump next year as we get closer to a budget. But again, I'm old enough to remember the bad days when you feared budgets. So anything that puts an extra £1 in your pocket is very welcome. I don't understand why we're not changing the exemption limits. It will be a big help for a lot of people from an admin point of view if we brought that up a little bit, considering tax bans and tax credits have gone up so much. We haven't changed the interest or the exemption limits for, I said, nearly 20 years. So all the main tax credits went up €100, and except the incapacitated child, which up 200. Very quickly, just to pause on these three, because we get asked a lot of questions about these. They're in tax credit. Now, the funny thing about these is I talked with 20 odd colleagues over the weekend because we tried to get as much of this drafted before the budget as we can, so we can just slot in the figures. No one had 750 here, everyone had 1,000, right? And I didn't find that where David Drum got his numbers. We got that from very reliable sources. So whatever happened between Monday and Tuesday, that went from 1,000 back to 750, I don't know, 250 off, so you had to go to keep some other minister happy. But the good news is they now realise that digs, as we call it, rent a room, lodgings, whatever, they should qualify going forward, and that will be back into last year. The bad news is there's no sign of simplification. And actually, full enough, a lot of the to talk to people last night on prime time and things, and one of the person they were talking about from the private sector made a comment. There's an assumption that the relationship between landlord and tenant is a lot more cordial and professional than it is in practice. And that was never more emphasized than in the sheer level of information you need to claim the rent credit, right? So We were hoping for a simplification of that. There's no sign of it happening. The one-off mortgage interest relief, I got a text last night saying mortgage interest is back with a big exclamation mark. No, it's not, all right? Mortgage interest relief had an entire infrastructure built around it where the banks applied the relief at source. This is a tax credit. The one thing about tax credits is they're easily dismissed. This isn't for you or me. This, and I'm very welcoming of this, by the way, but a lot of people complaining, I fixed my mortgage last year in anticipation of the recession that Daniel was talking about earlier on. That was inevitable, but never happened. But if your interest rate went from, if bear in mind it's capped at mortgages of 500,000 and it's capped at 600 or 6,250. So you're sitting there going, if you have a mortgage of between 80 and 500, your interest rate didn't jump by 6,000 or by more than 6,000, so much more that they had to cap it between last year and this year, right? Unfortunately, the answer to that question is for a lot of people, yes, it did. A lot of people's funds, mortgages were bought by funds, and there's people here who went from paying relatively normal in mortgage rates to suddenly paying 8 or 9%. And this relief is very welcome for them. But most people who've gone from paying 2% up to 3 or 4%, you're not going to see a big difference. You get 20% of the increase, and it's not going to change your life. But for those who are in the bad mortgage sector, that's a very important thing, and they actually will probably utilize the full cap of 1,250. So very welcome, but I think this is more of an emergency measure for the worst affected as opposed to a return to mortgage interest relief for everyone. But we'll see, right? But it's gone in as a tax credit, not as a new regime. The landlord's rental relief, this is one of those ones that the revenue published more information than the minister, which is never a good thing, right? And the minister announced that your great news for landlords that you won't pay tax on the first 3,000 next year, the first 4,000 year after that. That's not strictly true. You will pay tax, right? Unless you're only a marginal rate taxpayer or a nominal rate taxpayer, but even then you'll pay the other taxes anyway. So how it's going to work is the first 20% of your rent, 20% of your rent for the first 3,000 euros will be relieved, right? If you're a marginal rate taxpayer, you're still going to pay 22% plus whatever. It's per person and per property. So if I got 6 properties, I'm still capped at 3,000, so I'm still only getting 600. And if I jointly own one of those properties with Owen, we're going to have to share 300 quid each. There's another interesting thing in the revenues thing where it says individual landlords only, right? And only would make you think it's only for individuals, which would make you think partnerships and companies won't qualify. So it's going to be very interesting to see the small print when it comes out. So a lot of landlords giving out about, look, 11 quid a week isn't going to change my mind, but it's 11 quid a week. It's better than a poke in the eye. Now, for the accountants who are tuning in, or for the farmers, or for people looking to invest in farmland, this is one of those that sends an alarm bell off your head straight away. When I heard him announce the fact that to ensure only active farmers benefited from this, right? But no one, you're going to have to own the land for 7 years so you can have the farm letting exemption. Now, never has so much stupidity been packed into one sentence. And that's when my alarm bells start going off and going, hang on, we don't want active farmers benefiting from this. The whole point of this relief is to bring land that isn't being used by active farmers back into the active farming market. And this has the smell of the revenue about it. So I went looking, and I still think this is a revenue measure. I don't think the minister will bring this in because it has no purpose. And what it says is that where a person buys land at market value, he can't get farm leasing exemption for 7 years. And that is to discourage all of our wealthy clients from going out and buying farmland as an investment and stop real farmers from buying it, allegedly. I have no idea why we want to stop that, because again, the whole purpose of the farm letting exemption is to encourage people to give farmers 10, 15 plus year leases to use the land. If that's the purpose, why do we care who owns it? Right. My friends, this is the beginning and the end of the farm leasing exemption. Okay, this is how it. This is what the revenue do. I mean, obviously we don't want to touch relief, but you don't want those lads to have it, or those lads, or those lads, or you, right? So anyone who has a farm in their background, with their uncle or their aunt or their mother or their sons or whatever, and you're taking a transfer land or you're taking a buying land, or you have land, or you have money sitting in cash, you're looking, I might buy farmland because I agree with Daniel, cash is dead money. Not what you said, Daniel, I'm going to paraphrase. They can sue me, not you. But they mightn't like shares and they're going to go, I like the idea of getting half 1% return because it's tax free. Well, I'm not recommending it, but you better do it soon, okay? USC's got up. I guess it was particularly disappointing because I had heard that Mickey McGrath wanted to leave his mark, wanted to say, hang on, lads, there's a new sheriff in town. And the USC was the tool he was going to use. And I goes, this is great because USC is an absolute farce, right? It's an embarrassment of a measure in the tax system. And if you think I'm being too harsh, remember, this is not an income tax, it's tax on income, right? Which isn't a joke. It's a fucking logistical nightmare. If I would have to try and do a double tax rate calculation, a fecker over with USC to get it down to from 50 euros to 48 euros. It was a temporary measure, so it's okay. It's only 2011, I think. Temporary does, to quote the Princess Bride, they keep using that word, I don't think it means what they think it means, right? So when I heard Michael McGrath was coming in and this was going to be the tool he used to sort of new sheriff in town, I was expecting great things. I wasn't expecting to go from 4.5% to 4%. Right, I wasn't so much underwhelmed as I was basically halfway to Australia whelmed, right? So we'll see what happens in the next couple of years. I live for the day when that relief is gone, and it will happen. That tax spending is gone. It will happen. Again, I'm old enough to remember the income levy, which was a temporary measure that stuck around for a long time as well. I was looking forward to seeing the changes in PRSI and pensions because we know they're coming. They've been well flagged. 0.1%, that isn't it. I don't know what's going on there. I don't know if that's because they reckon auto enrollment and just the enhancements of PRSAs and so forth means they don't have to fund a bigger gap, or whether they're waiting for the next government to have to do this. I don't know, right? But 0.1% isn't going to fill the gap that they were talking about. They were talking about employer contributions of 12 and 15%, and individuals at one stage 8% was being mentioned, right? So we'll see how that plans out. It does mean, and yeah, another thing with that, by the way, is it does go into effect until next October. No idea where that is either. BIK on vehicles is very welcome. Just to flag this for anyone listening, because a lot of people missed it. As part of the cost of living thing, they brought in a 10,000 reduction when you're calculating the BIK on cars and vans. A lot of people miss this, and I mean a lot of people. As recently as last week, we came and doing tax returns to people. We asked them just as a double check. We had 3 people in one day who had never adjusted their BIK, right? So the BIK, anyone with a company car or company van, the BIK should be reduced by, you reduce the market value by 10,000 euros. That's now put into legislation. It'll be there till the end of next year, right? They're also delaying the phasing out of the electric cars. Again, I have been a sympathy for Mike regarding this one because this mess was here before he got there, so he could do nothing but slow it down. It doesn't matter. Once uncertainty comes into it, it's all over. Electric cars were booming out the window. As soon as the doubt about the exemption came in, everyone flipped back. So the minimum wage is going up, and it was a great, those box in the streets where they stop and put a microphone in front of someone and ask them what they think of the budget. Somewhere there's a YouTube channel where they show all the responses that they weren't allowed to put on the air that I would love to watch, right? But there was one great one with a guy going, why are we talking about the minimum wage? What's that got to do with the budget? The state doesn't pay that, I do. And I thought, actually, he's right. That's a great thing. Because if you think about it, if you're a small Irish business with 10 employees, you just got an extra 30,000 bill next year. Right? And all the other Mickey Mouse stuff about fucking energy credits and all this isn't going to amount to 30,000. So why did it say that part of the budget? So they distract you with all the penny sweets that they're giving you over there, I think is the answer to that question. The KEEP scheme, they finally got permission to enhance it. A lot of you know what the KEEP scheme is. Don't worry about it. It doesn't work anyway. They're having another bunch for reworking the EIS and the SCI and the SURE schemes because they just don't feel private investment is where it needs to be. And this is about the 55th time they're going to fine tune it. If you're not involved in that, don't worry about it. It doesn't work anyway. They're going to look at share-based remuneration again. There was a great line where the interest regime and withholding tax and interest capitation and all this with Arcady basically said, look, it's very complicated. He's not going to do anything this time. He's going to have to take time to look at it. And I goes, you're right, Michael. It is very complicated. You're only the Minister for Finance with 4,000 people working for you and you spend 50 billion on outside consultants. You need 6 months to look at it. My clients, however, got an e-brief saying, you need to worry about this now. We got a quote for someone to have a look at it. They thought this would be 25 grand to read our question, not to answer our question. So I love the fact that he takes 6 months, but the rest of us have to do it straight away. Vehicle or two top property taxes I want to flag for your attention. We spoke of them last year, so I know because you all listened to me avidly. You said, Brendan, what happened with these property taxes? We're on tenterhooks since last year. Well, I did say that the vacant home tax was very interesting because they're out bringing in an entire new tax regime and an online portal. An entire new tax system was introduced, and call me suspicious, but I didn't think they went to all that trouble for 4 million. Right, and I suspected there would be two aspects to this. There would be a lot of data gathering, and Jesus was right, and that the tax rate would go up. They didn't even wait for us to pay the first lot. You haven't even paid the first level of VHT, and they've already tripled it or doubled it from 3 to 5. Right? Now that's not doubling, but it is when you take into account inflation in my world, right? So if you're sitting there saying, that's what people holiday homes, it's not. Most people holiday homes won't pay this. What will get caught with people who have dormant or vacant homes, or they inherited an old cottage from an aunt, or they've got an old farm and there's a labourer's cottage on it. A lot of people are going to get surprised with the VHT. And the first time they're going to know they pay it is when they get a demand 4 years later, and it's going to be quite expensive. What I'm flagging for you, for all the left-wing pinko conspiracy theorists who listen to this, stop and get distracted by the nonsense. You don't have to look far. Look at the legislation here. Every homeowner in Ireland is now obliged by law to retain their refuge and energy bills for at least 6 years, right? Or they can be sanctioned and fined. Okay, just to be clear, that's what the legislation says. Now I've been assured, yeah, but like I know that's what the law says, but you have to trust the revenue. You don't have to trust the revenue, right? Same with residential zone land tax. This was very funny for us because as recently as 2 weeks ago, we were on a webinar with the revenue commissioners, and there's people saying, no one knows about this. No one knows about this. And the revenue were sure, no, it's been a huge publicity campaign. No, telling the Farmers Journal isn't telling the rest of the world, right? No one knows about this. And when it turns out they did their research and no one knows about this, so they've had to delay it for a year, okay? Can I just flag fee? If you're sitting there going, residential zone land tax is not for developers with all the thousands of acres you own up in Dalkey and out in Douglas, no. If you've got a house and a garden, and the garden's over an acre, you've got an issue. Simple as that. You might have a liability, you certainly have a form to fill. So anyone who owns a house that has over an acre has an issue. As a matter of fact, technically, if you have an acre and it's not part of your garden, you could have an issue, right? And you're going, so how does that work? Well, you might have a small house with a small bit of land and a small bit of land across the way. You might only have half an acre, but there might be a road between the two of them. You've got RZNT for the one across the road, right? It's another one of these taxes that has a far wider range than people think it does. But do you know what? I told you all that last year. You didn't listen to me then, you won't listen to me now. Right? Retirement relief, again, for any of the accountants listening. Alarm bells. Okay, it's being sold as a good thing. For no one, they'd only put a cap, the 5 million or 3 million cap they used to apply as 66 will only apply as 70. And by the way, there's now a cap of 10 million. And you're thinking, so who's that going to affect? Well, a lot of people, it'll affect a lot more when 10 million becomes 5 million, becomes 3 million, okay? And then there's the angel investor relief, which is a new form of entrepreneur relief. Don't worry about it. It's not going to, right? I read a great line, which is, I hope they don't make it too, I can't remember the phrase they use. I said I remember because it's a lot nicer than make us say it. But basically, the worry was that they'd tie it up with so much of conditions and red tape that it would be unworkable. Don't worry, they've done that. So we can look at it when the finance bill comes out, but no, it's not going to work. Too many baggage. Right? No moving indexation. So Ireland is still the only country in the world where you pay tax on gains that are actually losses. No move in the annual exemption. To put this in context, if they had kept up with inflation, the first 4.5 grand would be exempt. We're still stuck on 1,270. Right? No need to change entrepreneur relief. There was a report on this hidden in the documentation. It turns out that the moment they promised they'll go to 1 million to 3 million to 5 million. It turns out, no, we're not going to go from 1 million to 3 million to 5 million, but we might keep the relief. No change in CAT, right? Except for foster families, which we can talk about in Q&A if anyone cares about it. No changes in VAT. I have a little bit of sympathy for the tourism sector. Tourism sector isn't always hotels in Dublin that charge you $4,000 to have a hotel room when Garth Brooks is passing by, all right? The tourism sector is huge in rural Ireland. They don't have the same income that the rest of the bad guys do, for want of a better phrase. 9% would be important to them, but look, it's important to everyone. A lot of people thought it might come back, it hasn't. The registration thresholds have gone up. I think they changed around, I think they went from 35 to 37 in around 2008. Don't hold me to that, but I think it was around then, which means that inflation wise, we're still a couple of grand behind where we were, okay? So a few things, just simplification, we'll talk about that in a second. Share-based remuneration, we'll talk about that. Philanthropy could be interesting, right? We'll talk about that when it comes, we'll see where it goes. The taxation of funds report hasn't issued, so he's parked that up to next year. That has the same problem we have with electric cars and pensions. Once you put doubt into the equation, you're at nothing, right? So this is what we talked about last year about what we'll see what happens when Michael McGrath gets in and the things that are on the list to be changed. And the answer to those things is no, there's a 0.1% on PRSI. They did curtail reliefs, which is a warning sign that the revenue was still running the show. They didn't do anything about closed companies or service companies or anti-avoidance. They didn't do anything about employee expenses, which has been on their list since 2014, except make us report stuff to make sure we're doing something right without telling us how to do it right, etc. So where are we? What was my take of it? Well, first of all, it was a very hard budget to listen to, right? I thought Michael McGrath did okay. I don't know how Pascal got on. I fell asleep. Woke up, got married, drove home, came back, had a shower, came back, and he was still talking. I tried to read his speech last night, but I'm waiting for Netflix to make it into a mini-series. I thought, listening to it, I was completely lost. Because I'm only a humble tax consultant. I'm totally lost as to how we can simultaneously have a problem where landlords don't think it's worth their while staying in the market, but we have to give people rent relief because they can't afford the rent. Who's making the money if it's not the landlords, right? I don't understand how we have a housing problem because there's not enough houses being bought and sold, but we're having to give money to people to stop them selling their houses. Right? It might all make sense, not to me. But most of all, and I'm not saying for this, you can't bring in a carbon tax and you can't bring in these levies and excises to discourage the use of electricity, which is what this is for, and then give people credits so they can keep using the same amount of electricity, right? It can't be done. And a guy explained this to me brilliantly the other day, and we're all Irish, or most people are Irish listening to this, and if you're Irish, someone in your family or circle would have had a drink problem once upon a time. And when they decided to go off to drink the first 6 times, there was always one of their mates who would pull them aside and go, look, you can't go off it that quick. Here's a nagging, keep it to yourself, right? And that's all I can think of. Now you have to cut down on your consumption. But don't tell your mother, here's 150 quid, right? There's no consistency in this whatsoever. I couldn't understand half the stuff that was going on in this budget. And even the inherent contradictions, our entire tax package was worth 1.1 billion, but our personal tax package was worth 1.3 billion. Was the rest of the taxes minus 0.2 billion or something? I don't know. So in terms of what the message in the budget was, I don't know. There's a great line from a Kerry man, Sean, as there always is. It actually had nothing to do with tax. It had to do when they brought in PRSAs and how PRSAs were going to be for everyone. And the famous Kerry politician said, well, if it's something for everyone, it really means there's nothing for anyone, right? And I think actually that came to mind looking at yesterday's budget when they tried to give everyone nothing, ended up getting nothing. Very quickly, in terms of the takeaways as an investor, stroke what you do with your money. If you're thinking of doing something with a farm, either through an inheritance or transfer, or farming it or not farming it or buying it, do it quickly. If you or your family are involved in a family business that hasn't yet skipped down through the generations, you need to act now. You need to accept that entrepreneur relief and retirement relief and things like that are on the chopping block, which means pensions are going to have to become part of your tax plan. Right? Yes, Owen, you're lucky you're sitting down. I'm coming on board because if you can't get your money out of a company or you can't control the value of a company, you're going to have to look at moving money from your company into pensions and leave it sit there so that that can pass through your estate, right? It's not by choice, it's just they're closing off all your options to you. The mess that's going on with EIS and the entrepreneur relief and all that means private share investments are still not attractive. They're a punt. I'm not saying don't do it, but if I had 100 grand tomorrow, I'd much rather give it to Daniel, see what he can do with it, than give it to some guy down the road who has a new IT startup, right? The tax system is supposed to give him an edge over Daniel. It doesn't. And until we sort that out, it won't. On the other side of that, there is a major change going on around the taxation of investments. The problem is I haven't a fucking clue what it is. I don't think anyone does. But would you really lock your money into a fund for the next 4 or 5 years, pending clarification of how they're going to be taxed for the next 10 or 15 years? And last but not least, because it's boring, but it's very, very effective, the small gift exemption of €3,000 a year needs to be top of anyone's agenda when it comes to continue or passing on wealth to the next generation. Now, I've worked with Owen and Sean in the past. We've got clients, as soon as they have a grandchild, they'll put an investment structure around this. Owen will remember the numbers off the top of his head, because we did it when you put in 3 grand a year from 18, and I think he got an extra 114,000 just through growth, tax-free or something like that, right? And that was fairly conservative. I'm flagging that hard now because the small gift exemption mightn't always be there, and it mightn't always be easily to take advantage of, and it mightn't always be €3,000, right? It's definitely on the revenues hit list, which means we've got maybe 3 to 5 years. You can do a lot for 3 to 5 years. So, and as always, it's a finance act and a finance bill and a finance act that counts, not the budget. So keep an eye on them when they happen, especially around Christmas week. That's when all the sneaky stuff gets stuck in there. And back to you, Owen, I think.
Okay, thank you, Brendan. Very entertaining. I've listened to comedians who made me laugh less than you managed to do there. So thank you. So just a couple of questions. First one, Daniel, is for you. It's somebody, they just said, look, that clearly equities is the place for the long term. I think there is little doubt about that, but their question is to do with short-term money. So in their situation, they have a real reason not to be taking, I suppose, a risk with it. It's for a house purchase in maybe 2 years' time. They have money sitting in deposit, getting about 2% per annum fixed. Should they consider something like that 3.6% bond, or even a 2-year German bond with 2 years left to run, so they're fairly certain on their outcome? Would that be a better outcome for them?
Yeah, it is, you know, and again, I won't step into the tax advisory side of that, but just at a headline level, if you think of the gross returns there, 2% from an Irish bank, say, and 3.7-ish from the German government, it's one of those rare situations where, almost unique situations, where you get a higher return for lower risk. I'm not for 1 minute do I think any Irish banks are in any danger of going and getting into difficulty. But the fact is that the German government is objectively lower risk than any private bank in any country, anywhere in the world. So you're getting a potential high return. So once the calculation is done, that after costs and after tax, if you're coming out with a better result from the German government, then to me, it's almost a non-decision.
Okay, no, thank you. Brendan, for you there, the rent tax credit that you mentioned that is now increased, that's standing at €750. There's a question, if I'm sending a child to college and they're living in on-campus accommodation, will this relief apply?
Yeah, if you're paying the rent, it'll apply, right? Yeah, well, I better check that there was one of the problems was with the thing is there was a requirement you had to be RTB registered, but the RTB has a lot of exemptions. So a lot of people fell out of the loop, but by accident, right? In other words, they're official, they're just not able to register. That's where the digs thing was a problem. So tell that person to email me, I'll just double check that campuses aren't exempt from RTB registrations. But no, as far as I'm aware, if they are, that's the kind of stuff that's supposed to be getting fixed and retrospectively applied.
Sure, I have you. And Brendan, this is more a comment than a question, but feel free to reply, right? When you mention contradictions and that tenants paying very high rents, but landlords are running out of the market, right? And you meant who's making the money if not the landlord? So the person here has commented that, well, clearly people making the money here are the revenue, getting 52% of the rent. So that that's who's getting the money in the
Well,
situation.
My point here, I'm not slating landlords at all, right? Because they're all my clients. But that's my point. If the state is making the money, why is the state pretending, oh, we have to help these people? You're the people taking the money off them, right? And to be honest with you, in my experience with dealing with clients who are landlords, it's not even the tax. It's the RTB and the fines if you're late. It's the LPT and the fines if you're late. Do you know what I mean? It's the 50 different forms you have to fill out, the BER ratings. It's a full-time job just trying to fill up forms. It's not even the cost of the tax, it's the cost of the admin and then all the fines and sanctions because you missed one of the 4,000 things you have to do.
Yeah.
It's the state is doing that.
Yeah.
So stop. My point is be consistent. If you want to help these people, then stop kicking them in the throat.
Yeah.
Don't be kicking them going, Jesus, who's doing this? Well, you know, it's you, right?
No, I have you. No, gentlemen, that's it. Thank you very much. Bang on time. Thank you for.
Can I interrupt? I have questions for both of you, if you don't mind.
Okay.
Not to, just because I was listening to you. Well, the first one is for you.
Yeah.
Because one of the things I mentioned there is, as we become harder and harder to shift family companies where the value goes above a certain level, you're going to have to relocate the value from the company into pensions, right?
Yeah.
Now, it's a double thing. Number one, am I right in thinking that, well, I won't lead you. I won't lead you. If I have £1 million in and I put into a PRSA because I need it out of my company, right? And I'm already wealthy, I don't want to have to pay 4% a year. How long can I delay crystallizing that so that it grows tax-free?
I have you. Well, thankfully, you gave me a question I can answer. Age 75 with the PRSA. So that's and like the PRSA has become a very improved product. Up until now, if somebody came and they had a large number like that, I want to put 1 million into my pension fund, I would have had an awful lot of work to do. I'd be checking out their salary. I'd be asking them all sorts of questions around existing pension funding. I'd have to do a pension funding quote. I might have to come back to them and say, you can't get 1 million in, but based on the numbers you've given me, you can get 700,000 in. If you want to get 1 million in, your salary has to go up. So there've been a lot of those conversations. Those conversations have disappeared now with the PRSA. You know, all this, it means that like that 1 million can go across into a PRSA. There's no funding checks. Now, of course, underpinning all this has to be, you know, a bona fide employment. I would be very cautious. I mean, look, you know,
there is still a bona fide tax thing. It has to be commensurate with your role.
There you go. So look, if somebody's working in the company, they're working there full time, I don't see a problem with that. If all of a sudden their spouse comes on the books and there's going to be a big PRSA contribution, I'm going to see a problem with that. And certainly employing children for a short period of time and making a big whopper of a PRSA transfer like that.
The 16-year-olds with 1 million in the PRSA.
Yeah, I won't be the financial advisor involved in that transaction if it is to happen. I can tell you that much.
But just to be clear, because if you're 60, so I do this at 55, and I hit 60, nothing happens. I can leave my PRSA there and just grow tax-free away until I'm 75.
Up until age 75, and then you'll be forced to act on it. You'll take your tax-free lump sum, and you will then trigger an ARF. Yeah. But so you can leave all this on top.
But then I'm only taking 4% for the rest of my life from 75.
Well, 4% in your 60s, 5% in your 70s. But
but the point is, I don't have to draw it all down. So one of two things happens: I die and it goes out, and it goes on from my company to my estate tax efficiently, or I live until I'm 100.
This
and
is
who gives a shit, right? So
now that is, I would phrase that as some morbid tax planning, right? So what you mentioned there is that it would be very tax efficient for that person to transfer out 1 million, 2 million, and then to leave it in an uncrystallized PRSA and die, right? Because at that point, the money then comes out of that tax-free into the person's estate. Now, clearly subject to CAT, but if a spouse is getting it, they're going to get it tax-free. And then, of course, as I've said that to one or two people, they said, look, that's not a great plan. And I said, okay, it's not. But at least you can put things off until age 75. And then look, at that point, you are forced to act on it at that point. But I suppose it's going to tick a box for a lot of people.
It's like everything else. There's a club in the bag that's not for everyone. But when it's the right club, there's nothing like it, right? No, I'm glad you answered that because that was my second question for Daniel and yourself, right? If you don't mind, Daniel.
Mhm.
If I am 60 years of age and I am fairly wealthy and I've stuck, for argument's sake, 2 million quid, 1 million for me, 1 million for my wife, because unlike Owen, I respect the working women of Ireland who come onto the books late because, you know, it wasn't worth their while paying them. You've just been social media, Owen. I respect, the reality of it is for years, spouses weren't on the books because it didn't matter. Now it suddenly matters. But the fact they are already working in the business, we put 1 million quid in, there's 2 million inside in the fund. Both of them are independently wealthy. We don't want it. They're 60 years of age. I want in the PRSA, and I don't want it until they're dead, but I certainly don't want it until 75. Now, my question is this. You don't have to answer honestly, but you can if you want to. Knowing that you've got 15 years, would you change your investment approach, given that there's 60 traditionally you would have gone very conservative cash-based? Knowing that you have 2 of them and you have 15 years, would you change your investment approach so that, and would it be possible for the PRSA and the funds in the PRSA not to fall foul of that inflation creep that you were talking about?
Yeah, well, I might initially have a stab at that one. One of the massive changes since we've gone into a world where you can get an approved retirement fund is this idea that the day I retire, my assets is the be all and end all. The value on that exact day dictates my income throughout my retirement. That's gone. So the day PRSAs crystallize into an ARF, and in this case, it might be until they're 75. That's just an important stop, but on a much longer journey. A big mistake I think that often people make around pensions is to look too narrowly at age and make asset allocation decisions based on just something as simple as, well, I'm 60 now. We need a much broader view than just looking at age. And you've sketched it out there. These people don't necessarily need the money. Well, in that case, one of the few things we can be certain about is actuarial life expectancy. That the statistics are there. So if a couple are, say, even if they're a bit older, if a couple are 65 years old, there's a 50% chance, more or less, that at least one of them will live to 90. So if you think about that, that means in a pensions world where an ARF would transfer to the surviving spouse, you're talking about this couple very realistically have a high chance that at age 60 that they might have 3 decades of investment ahead of them. That's not a stretch to think that. In that case, and particularly where there's other resources elsewhere and they're not living or dying with the value of the PRSA, it would be a mistake to be too cautious with those funds, in my opinion. It'd be a very big mistake to be too cautious and to run away from anything volatile and to say, we'll be prudent here, we'll sit in cash, because 20, 30 years down the line, they'll wonder what happened to their purchasing power.
I've kind of similar points to make. And it's just to say that, if you go back 20 years or more, right, before the ARF came into existence, there was very much the standard advice was to de-risk as you get close to retirement age. So in other words, you'd be decreasing your equity content and increasing your bond content. And the idea there was you had to buy an annuity at 65 at your retirement age. So you had an appropriate asset class that matched the annuity you were going to buy. More than 20 years ago, Charlie McCreevy gave us the ARF, which just changed the game totally, which means now that people are not invested just until age 65. They can be invested until their dying day, which is pretty much along the lines of what Dan was saying. So I think
when you die and it goes to your spouse, the ARF doesn't crystallize per se. The investment can continue on for her life as well, yes?
Yes. Yeah. And then when the spouse passes away, that money can go to children at it's kind of a special tax rate of 30%. So there is good capital preservation.
The consensus is, lads, age is nothing but a number. Right?
That's it.
I don't think we've coined that, but I'll claim it.
Yeah.
Okay.
So Brendan, I'm hopeful you're stopping at 2 questions.
No, well, I think it's a game changer, Owen. Right? Yeah. That's the reality of it. And you hit the nail on the head. Traditionally, as you get to 60, you need to slow down. But at the same time, as Daniel pointed out, that's not good to you because you're losing money every day with inflation creep, right? So 80 is the new 60, as long as especially when there's 2 of you there. That's the reality of it.
Yeah. Oh, agreed. Perfect. Listen, thanks to everybody. Thanks to our panelists. Thanks for everyone who took the time to be with us here today. And look, have a good day, and we'll be organising one of these again early next year. So hopefully we'll see everyone again. Okay, thank you.
Thank you.
Thanks, everyone.